Dear students, good morning to everyone. Let's start the last topic of FR. The last topic of financial reporting is the final accounts. So finally, the time has come that we should start the last topic, final accounts. Basically, in final account, what happens? Number one, you need to have the knowledge of almost each and every IAS and IFRSs. Second, in final account, basically you will be required to prepare statement of financial position, profit and loss for a single entity. Logically, you have already seen the final accounts, but that was group account. Now, in here, we'll be dealing with a single company. Number one. Number two, examiner is going to give you around 4 to 5 or maybe 6 to 7 adjustments. You have to deal with each adjustment separately, number one. And number two, you can easily deal with every adjustment if you have a really good grip on ISS and IFRS. So let's deal with the question. This question came in June 2022. So obviously you cannot say it's a very old question. Take it as a very recent question, I would say. So June 2022. Let's see what they are asking. Prepare a statement of profit and loss for print company for the year ended 30th June X2, 8 marks. Statement of financial position for print company, 12 marks. It's a 20 marks question. Okay. So basically in section C, one question obviously on consolidation, and the second either is going to be on final accounts or it can be on, let's say, interpretation of financial statements, that is ratio analysis. Print company is a manufacturing company, has the following trial balance at 30th June X2. They have given you the trial balance. We know that this is the debit side and this is credit side. Okay. Let's read the required information. The following additional information is available. Remember, we need to just prepare profit and loss and SOFP. Number one, on 1st January X2, start of the year, not start of the year, mid of the year. On 1st January X2, print company raised funds, which is 30 million mid of the year, okay? Because their year end is June. So they raised 30 million. The full amount was recorded in the nominal ledger as a bank loan. So the entire 30 million is recorded as a bank loan, okay? The funds actually consist of a bank loan of 16 million. Wow, wow, wow. They have raised 30 million and they have recorded entire 30 million as a bank loan, but actually entire 30 is not a bank loan. Bank loan is only 16 million. Then whatever the rest of 14. And 14 million from issue of 7 million $1 ordinary shares. So logically out of this 14 million is they have raised by issuing shares. How many shares? 7 million shares. We know that when we record share issue, with the par value share capital will be credited and over and above share premium will be credited. So what error they have made, instead of basically taking 16 million as a loan, they have taken entire 30 million as loan. Number one. Number two, they have not recorded the share capital and share premium. Interest is payable on a loan 5% per annum. An accrual for 6 months interest has been included in the trade and other payables, recognized as a finance cost. Another mistake is they have recognized the accrued interest obviously over 30 million instead of 16 million, because the loan is not 30, the loan is actually 16. However, the calculation of interest was incorrectly based on the nominal ledger loan balance, which is 30. So let me just show you the correction of, let's go for working one. Working one. Basically, we have to do the correction of error. So let's do that. They have included accrued interest on the entire 30 million. So let me first deal with the finance cost. I'm ignoring 3 zeros. So included in the trial balance, included in trial balance. Basically, in trial balance, they have taken in, they have charged and they've recorded the interest over 30 million for 6 months. This is 750. Logically, they should have recorded the interest only on 16 million. So we have to do the correction of error. So simply less the correction of error. They have charged more interest. So 14 million. They should have charged interest only on 16 million, but they have charged on 30. So we have to reverse the interest on 14 million. I'm getting 350. So logically, the finance cost should be 400, not 750. But error does not stop here. One more thing, what is that? We have to reduce the bank loan amount by 14 million because actually the loan is 30. It is not, the loan is 16 million. It's not 30 million. So 14 million should go to share capital and share premium. So it means one more working. Correction of share issue. Correction of shares issue and bank loan. They have issued 7 million shares, par value is 1. So basically the share capital will increase by par value. 7,000 shares into $1, which is a par value. It is 7,000. So basically 7,000 is the share capital and over and above is the share premium. Total amount raised through share issue is 14 million. If 7 goes to share capital, then 7 is the share premium. So we have to basically reduce the loan by 14 million. So 14 million is the proceed received incorrectly included as a bank loan. Proceeds received incorrectly included as part of bank loan. The working is good enough. If you want to make a double entry, it's up to you, but it is not required. I just want to give you an idea, debit and credit. You will debit the bank loan by 14 million. Obviously, when I'm going to debit the bank loan, so loan will be reduced. Share capital will be credited by 7 million and share premium will be credited by 7 million. Logically, this is the correcting entry, but examiner has not asked us the entry. Just for the sake of your knowledge, we have made this entry. Okay, now. Done with the adjustment number 1. Now let's deal with adjustment number 2. Inventories, we know that inventories, IAS2 applies and IAS2 says cost of NRV, whichever is lower. Inventories at 30th June X2 were initially valued at cost 5.7 million. So initially the inventory was valued at 5.7 million. This includes 700 units with a cost of 1400 per unit. Okay. In order to sell these items, they need additional processing cost 400. At which point they can be sold for 1600 per unit. So after additional processing cost of 400, it will be sold for 1600. So basically, selling price minus the additional processing cost will give us net realizable value, which is 1200. Logically, now the net realizable value is lower than the cost. And according to IAS2, stock will be valued at a lower of cost or NRV, whichever is lower. So initially the cost is obviously 1400, but now the NRV is 1200. So we have to reduce the inventory from cost to the NRV. So let's go for working 3. Inventory 700 units. Basically, this 5.7 million includes 700 units at 1400. Okay. So the 700 units, they required modification. Simply cost of units requiring modification. Cost of units requiring modification. 700 units in, they are kept at cost, which is 1400. So I'm getting 980. Now, obviously, their NRV is obviously reduced. Net realizable value is 1600 minus 400 into 700. I'm getting 840. So inventory will be written down by 140. We have to reduce the inventory from 980 to 840. It means there will be inventory written down 140. Inventory write down is required. So basically closing inventory, which is 5.7 million, it will be reduced by 140. Closing inventory, which they have given us 5,700 less inventory write down. Inventory write down. So it will become 5560. So logically, the closing inventory is 5560. That was adjustment number 2. Let's deal with adjustment number 3 now. Okay. At 30th June, X2 print company has a contract to purchase 22,500 electrical components over the next 3 years at a cost of 450 each. At the year end, print company has a contract to purchase how many electrical components? 22,500 over the next 3 years at a cost of 450. Okay. These purchases are made at a constant rate, which means 450. These components are no longer required for their initial purpose, but do have an alternative use, which will require additional manufacturing cost 600. It means that first you have to bear the cost of 450 per unit, and they're not required for initial purposes, but they can be used for an alternative use. But for using this for an alternative use, you have to incur additional cost of 600. It becomes 1050. Thereafter, each component can be sold for 900, but you will be able to sell it for 900. So logically, there is a loss per unit is 150. Loss per unit is 150. Alternatively, print company could cancel the contract immediately by paying a penalty of 4 million. So basically, point number 3 is a scenario of onerous contract, IAS 37. Onerous contract is a contract where cost of fulfilling the contract is more than the benefit. Onerous contract is a contract where cost of fulfilling the contract is more than the benefit. Under onerous contract, IAS 37 says you have to check all the possible alternatives. and then you will have to record a liability, but according to the alternative where you have to bear the less loss. So if you go for the penalty, you have to pay 4 million. Otherwise, per unit, you have to bear a loss of 150. Now, let's see what is the loss on fulfilling the contract. Loss on fulfilling contract. Basically, 22,500, they are the total units. Per unit, there will be a loss of 150. So if I ignore 3 zeros, so it's going to be 3375. So over 3 years, the loss is going to be 3375, which is lower than the penalty, which is 4 million. So obviously, it's better to go towards the loss on fulfilling the contract because this is less than the penalty amount. And obviously, entire 3370 will not be recognized in current and non-current. Basically, this 33750 will be break into current and non-current liabilities. So let's go for another working 4. Basically, we are dealing with onerous contract. Price per unit is 450. Additional cost which you have to bear, cost of conversion for alternative use, cost of conversion. So this will cost you 1050 total cost per unit. And the net realizable value is only 900. So logically, there's a loss per unit 150. Loss per unit is 150. So the total loss on fulfilling contract 22,500 into 150. 33750000. Let's bring 30 here. So the provision, the liability of 3375 will be recorded, but we have to break this into current and non-current liabilities. So loss which is expected in the next 12 months, that will be your current liability, and after 12, that is going to be your non-current liability. Loss expected in next 12 months. 3375 is over 3 years. So it is 1125. This will be your current liability. So 1120 is going to be simply our current liability for the provision, and non-current liability for the provision will be 3375 minus 1125. So this is when you need to deal how to deal with onerous contract. No, okay, ignore discounting. Any adjustment resulting from this information should be made to administrative expense. Okay. Now, adjustment number 4 on 1st July X1, start of there. The director of parent company decided to sell a piece of machinery. An asset met the criteria to be classified as held for sale at that date. So under IFRS 5, we know that you will have to keep the asset at lower of carrying amount and fair value less cost to sell. And once you have applied IFRS 5, after applying IFRS 5, no more depreciation. Another point, after applying IFRS 5, that non-current asset held for sale will be shown in your current assets. Okay. The machine cost is 2.4 million. Carrying amount is 1.5 on X1. At that date, its fair value less cost to sell was 1.14 million. At that date, its fair value less cost to sell was 1.14 million. Okay. The machine was sold for 1.1 million. After selling cost of July 1st July X2, no adjustment have been made to take account of classifying the machine as held for sale. Wow. They have not treated this as held. So let me just quickly show you the working. How many workings we have done? Working, let's go for working 5. Working 5 held for sale. Held for sale asset. According to IFRS 5, after applying IFRS 5, asset is kept at lower of carrying amount and fair value less cost to sell. So at 1st July X1, carrying amount at 1st July X1. They have given us the carrying amount 1500 and they have also given us the fair value less cost to sell. Fair value less cost to sell. Basically, fair value less cost to sell, they have given us 1140. So obviously we have to keep the asset at lower of 1500 and 1140. So it has to be at 1140. Simply, you can say that balancing figure is the impairment loss. So there's an impairment of 360. And now, a very important point, this asset is sold for 1.1 million on July X2. Now listen carefully. This asset is actually sold on 1st July X2 for 1.1 million. So it is quite obvious. The fair value less cost to sell on which they have actually sold the asset on 1st July X2 on 1.1 million. So the same fair value less cost to sell will be on 30th June X2. The fair value minus cost to sell, which is given on 1st July X2, it is obvious the same fair value less cost to sell will be on 30th June X2, which means that at the year end, 30th June X2, fair value less cost to sell is 1100. So there will be a further impairment of 40. Repeat. The criteria of held for sale is met at 1st July X2, X1. So after applying IFRS 5, asset has to be measured at lower of carrying amount and fair value minus cost to sell. At 1st July X2, the carrying amount is 1500 and fair value minus cost to sell is 1140. So at 1st July X2, we have to recognize the impairment. We have to charge the impairment loss of 360. Then this asset is actually sold for 1.1 million on 1st July X2. So obviously the fair value minus cost to sell, which is on 1st July X2, it is quite obvious. The same fair value minus cost to sell will be on 30th June X2. Obviously, on reporting date, we have to remeasure the fair value minus cost to sell. So on 30th June X2, it is 1.1 million. So we have to recognize further impairment loss of 40. So total impairment loss in this asset will be recorded, that is 400. Okay. Now what? Parent company policies to depreciate plant and machinery at 15% per annum on cost. To present the all complete depreciation will be taken to the cost of sale. Okay. Income tax refund for the year is 2.53 million. Wow, there's no income tax payable. Instead of that, there's income tax refundable. And how do they depreciate? They depreciate 15% per annum on cost. Let's see. Okay. We are having a plant and machinery. The plant and machinery cost is 16,200. Plant and machinery cost is 16,200, and from this 16,200, we have to deduct the asset which is held for sale. From this 16,200, we will have to deduct the cost of the asset which is held for sale. Okay. So let's work on this plant and machinery. And accumulated depreciation till 30th June next one, we have 7290. Accumulated depreciation till 7290 we have. Till 30th June next one, we have 7290. Okay. Land is 45,000. So let's work on plant and machinery. Working, I think 6. Working 6. Property, plant and equipment. Just take the cost, ignoring 3 zeros. Cost is 16,200. Less asset held for sale. The asset which is held for sale had a cost of 2.4 million is 2,400. So we are left with 13,800. And this print company depreciates 15% on cost, which means that depreciation expense for there, it will be 13,800 into 15%. I'm getting 2070. I'm getting 2070. Now you need to understand one thing. The accumulated depreciation which they have given us, it is 7290. The accumulated depreciation is 7290, but there is a problem. The problem is this 7290 is also having the impact of an asset which is now held for sale. Actually, I need to calculate the net book value of the plant and machinery, which is not held for sale. Obviously, in SOFP, I have to show the net book value. And asset which is held for sale, it will be shown separately under the current assets. Now, from this 7290, I need to deduct the accumulated depreciation of the asset which is held for sale. The asset which is held for sale is having a cost of 2,400. Repeat. The asset which is now held for sale, it is having a cost of 2.4 million. Net book value at the time of applying IFRS 5 is 1,500. So the difference between cost and net book value is the accumulated depreciation, which is 900. So logically, accumulated depreciation brought forward from 7290, I have to deduct this 900. Actually, 900 belongs to the asset which is now held for sale. 7290 minus, so I'm getting 6390. We have deducted the cost from the cost, and we have deducted accumulated depreciation from the accumulated depreciation. So we deducted the cost from the cost of cost, and we have deducted the accumulated depreciation from the accumulated depreciation. So 13,800 minus 2070 minus 6390. I'm getting 5340. I'm getting 5340. So that's working 6. Now let's go for working 7. Let's go for cost of sale. Let's see, do we have any opening inventory? We do have the opening inventory. 6850. Okay. In this 6850, we will add the production cost. Production cost, because we are a manufacturing company. 60,150. Then we'll deduct the closing inventory, which we have already calculated. Then we will add the depreciation charge, and we will also charge there's any impairment loss in the asset which is held for sale. So let me just quickly calculate cost of sale for you. Cost of sale. Opening inventory is 6850. Production cost they have given us 60,150. Less the closing inventory. Let's check the working of the closing inventory. Closing inventory is the working 3. 5560 working 3. Add depreciation charge. Working 6 depreciation charge. 2070. It is mentioned in the question the entire depreciation will go to cost of sale. Take the impairment of held for sale asset also to the cost of sale. Held for sale asset impairment. Held for sale asset impairment. It is basically 360 plus 40. And the working is, let me show you the working. Working 5, 360 and 40. So simply 6850 plus 60,150 minus 5560 plus 2070 and 400. I'm getting 63,910. So the cost of sale is 63,910. Okay. Now we can prepare I would say statement of profit and loss, and very easily we can prepare statement of SOFP as well. Now student, we can easily prepare statement of profit and loss for the year ended 30th June X2. Part A, basically statement of profit or loss. Statement of profit and loss for the year ended 30th June X2. And obviously we are ignoring 3 zeros. Revenue. Let's see. Revenue amount is 97,400. So the revenue is 97,000. Cost of sale, students, we have already calculated. Working 7. And the cost of sale is 63,391. 63,910. 63,910. That will give you a gross profit. 33,490. Let's go back to the trial balance. Distribution cost, we have 7,200. No adjustment is required in distribution cost. So distribution cost is 7,200. Now let's go to the admin expense. Let's see what they are saying. Admin. Administrative expense is 29,570. And look at this. Point number 3 relates to the onerous contract, and they're saying any adjustment resulting from this information should be made to the administration expense. So whatever adjustment is required for the onerous contract, obviously the double entry is P&L will be debit, provision will be credited. So you have to take that to the administration expense. It is mentioned in the question. Administration expense. Administrative expenses. Already in the trial balance, we have 29,570. Just add the provision of onerous contract. Obviously, the total provision. That is 3,375. And the working reference you have to give. Working 4. It is 3,375 working 4. 29,570 plus 3,375. So I'm getting 32,945. That will give us a profit from operations, means PBIT. Profit from operations. So 33,490 minus 7,200 minus 32,945. So I'm getting, in fact, instead of profit, there's a loss. 33,490 minus 7,200 and 32,945. 33,490, 7,200 and 32,945. So there's actually logically there's a loss from operations. So we're having a loss from operations 665,6655. Finance cost. Let's see. In the trial balance, what is the amount of the finance cost? It is 750. But there was a correction of error as well. Correction of error. 350 will be reduced from the finance cost, working 1. 350 will be reduced from the finance cost. So 750 minus 350, that is working 1, correction of error. So logically, the finance cost is 400. So that will give us a loss before tax. Loss before tax. 7055. That is why, since there's a loss in the business, that is why examiner has given us the income tax refund rather than income tax expense. Income tax refund. The amount of income tax refund is 2.53 million, means 2530, because we have ignored 3 zeros while doing all the calculations. The refund has to be in positive. So we are having a net loss 4525. So net loss for the period. Or even you can say loss after tax. Now, student, we can easily go towards SOFP, part B of the question. And we know that statement of financial position is always for a day. That is why we write as it. Statement of financial position as at 30th June X2. Just make two columns. Assets, obviously, first we have to take the non-current assets. Non-current assets. Let's take property, plant and equipment. Property, plant and equipment. Property, plant and equipment. The carrying amount is 5340. And we also have a land. Land value is 45,000. So the value is 5340. It is coming from working 6. So 45,000 is the land plus 5340 coming from working 6. So I'm having a non-current assets 50,340. No more non-current asset. Let's go for current assets. Inventories. Trade and other receivables. Trade and other receivables. We have tax refundable. So taxation, that is tax refundable. Bank. For inventories, I think we have calculated the correct amount of inventories. Inventories. It is 5560 and it's working 3. 5560 working 3. Trade and other receivables. Let's check the trial balance. Trade and other receivables. 25,010. 25,010. Tax refundable, we have seen 2530. Let's see the bank. Cash at bank is 4,700. Cash at bank is 4,700. So 5560, 25,010 plus 2530 plus 4,700 gives us 37,800. And if you just recall IFRS 5, so after applying IFRS 5, non-current asset will be reclassified to the current asset. So non-current asset held for sale is, you have to show under the current assets. So non-current asset held for sale. Let's see the working reference. Working reference, working. It's here. Working 5, 1100. Working 5. So actually, first you have to show the total of the current asset without non-current asset held for sale, and then you have to separately show the line item of non-current asset held for sale in the current asset. So the total of the current asset is coming 38,900. So current asset plus the non-current asset. Total is 89,240. So total assets are 89,240. Now, obviously, we'll go towards equity and liabilities. And obviously, first equity and then liabilities. And in liabilities, obviously, first non-current liabilities, then current liabilities. Equity and liabilities. Equity. Let's take the ordinary share capital. Ordinary share capital. Number one, we have to take the ordinary share capital from the trial balance, and plus there was a correction also. I'm getting 29,600. Other component of equity is 15,500. That is share premium. So we'll add the correction of error 7,000 plus 7. If you recall, I think it was adjustment number 1. No, it was adjustment number 2. That share capital will increase by 7, share premium will increase by 7. We also made a double entry for the explanation. Share capital will increase by 7, share premium will increase by 7, and bank loan will reduce by 14. So let's go there. So ordinary share capital, we have 29,600 plus 7,000 is coming from working 2. So 36,000. Other component of equity includes share premium. Other component of equity. Given is 15,500 plus take 7,000, that is working 2. I'll get 22,500. Okay. Then retained earnings. Since business is having a loss, so due to loss, retained earnings will reduce. Retained earnings will reduce rather than increase. Retained earnings. They are having 11,470, and this will reduce by 4,525 because 4,525 is loss after tax. In the income statement, you can see that we are having a loss of 4,525. If you want, you can show these equity items impact first in the first column and then total in the second column. Otherwise, you can directly show in the second column. It's acceptable, no issue at all. 11,470 minus 4,525. 6945. So it gives us the total equity, which is 66,045. Now let's go for non-current liabilities. Non-current liabilities. Bank loan. Actually 30,000 and there was a correction of 14,000. Working to. Let me show this in the first column, 16,000. And then onerous contract, the provision we broke into, we broken that into current and non-current liability. Provision. Working reference. Let's see the reference of the onerous contract working. Onerous contract is onerous contract is working for. Non-current is 2250 and the current is 1125. So non-current is 2250. Working for. So that will give us a non-current liabilities total 18,250. Current liabilities. Just take trade and other payables. Provision of onerous contract. Current liability is 1125 from the onerous contract. Trade and other payables. Let's see what is the amount of trade and other payables. Trade and other payables. Trade and other payable is 4170. Let's see, is there any adjustment in the trade and other payables? Look at this. An accrual for 6 months interest has been included in the trade and other payables and recognized as a finance cost. So actually we having 4170 also have the impact of accrued interest. We have no issue with that. The problem is entire accrued interest is not correct. Actually, the accrued interest is 750, but out of that 750, 350 was a correction of error. So if I just show you, your accrued interest will actually reduce by the 350. It's a correction of error. Working one. Working one. So 4170 minus 350, that is working one. I'm getting 3820. 3820 gives me 4945. So simply total equity and liabilities. Total equity and liabilities. 66,045 plus 18,250 plus 4945 gives us 89,240. So students, you can see that your total assets are equal to total liabilities. And this was a question from March-June 2022 attempt. And obviously it is the first question of final accounts as well. At least I would say, at least I'll be discussing 3 more questions on final accounts. And after 3 more questions on final accounts, your FR course will be completed. But obviously after the completion of the course, I'll give the homework 1 or 2 questions relating to the final accounts. But after the completion of the syllabus, of course, I'll be keep uploading the practice videos slowly and gradually. So that is the first question on final accounts. Slowly and gradually, you will get a really good command on the final accounts, but to have a really good grip on final accounts, you need to have a really good knowledge of IASs and IFRSs. It's a first question. Do not worry about anything else. Obviously, slowly and gradually, when number of questions will increase in final accounts, automatically you will get the confidence. Don't worry at all. Uh, After doing few more questions on final accounts, automatically you will get a really good grip on this topic. So thank you very much for watching this lecture. Have a nice life.